Have you ever wondered how companies decide on their capital structure? It's a question that often sparks curiosity. Today, we delve into the fascinating world of corporate finance, where the decisions about capital structure are made. Capital structure, if you're new to the term, refers to the mix of debt and equity that a company uses to finance its operations and growth. It's about striking a balance between borrowed money and owned capital. This balance is crucial because it impacts a company's risk, return, and ultimately its value. A multitude of factors come into play when deciding a company's capital structure. These can range from the business environment and market conditions to the company's individual characteristics and strategic objectives. Understanding capital structure is crucial for any financial analyst, and one of the key theories in this field is the net income (NI) theory of capital structure. To unravel the intricacies of capital structure, we must first delve into the net income theory. The net income theory, in essence, is an approach to understanding a company's capital structure. It's a financial theory that suggests the value of a firm can be influenced by how it finances its operations and growth. Now let's break it down further. The theory proposes that a company can increase its value by increasing its debt. Yes, you heard it right. Increasing debt. It might sound counterintuitive at first. We often associate debt with something negative, something to be avoided. But in the world of finance, debt can sometimes be a friend rather than a foe. Imagine this: a firm decides to finance its new project through debt rather than equity. This decision means that the firm is borrowing money instead of issuing additional shares to raise the necessary funds. According to the net income approach, this move could potentially increase the value of the firm. Why so? That's because, under this theory, the cost of debt is usually lower than the cost of equity. The firm, in essence, is replacing a higher cost source of finance with a cheaper one, thus saving on the cost of capital. This saving increases the net income of the firm, hence the name net income theory. Moreover, the interest paid on debt is tax deductible, further reducing the effective cost of debt and consequently increasing the firm's net income. The higher the net income, the higher the value of the firm according to this theory. But remember, this theory operates under the assumption of a perfect market, which in reality might not always be the case. There are risks and costs associated with debt that can't be overlooked. Nevertheless, the net income theory provides a fundamental understanding of how debt and equity can affect a company's value. Sounds intriguing, doesn't it? But how does it work? Let's delve deeper. The NI theory is built on certain assumptions which are fundamental to understanding its application. Now, let's delve into these assumptions. First of all, the NI theory presumes a world with no taxes. That's right, a world where tax codes and tax brackets are non-existent. This assumption simplifies the theory, allowing us to focus on the relationship between net income and capital structure, without the interference of tax implications. Second, the theory assumes that there are no bankruptcy costs. In other words, if a firm were to face financial distress or even go bankrupt, there would be no associated costs. This includes both direct costs like legal and administrative fees, and indirect costs such as the loss of customers and damaged business relationships. Thirdly, the theory assumes that every investor has the same expectations about the firm's future earnings. This means that all investors are in agreement about the company's future prospects, and there is no uncertainty or risk involved. Next, the theory posits that the firm's investment decisions are not affected by its financing decisions. This means the way a firm finances its operations, whether through debt or equity, does not influence the investment decisions it makes. Lastly, the theory assumes that the firm's dividend policy does not affect its capital structure. This implies that the firm's decision on how much profit to distribute as dividends and how much to retain for reinvestment does not impact its capital structure. These assumptions are crucial as they form the backbone of the net income theory. They allow us to isolate the effects of capital structure on a firm's value, providing a clear and simplified model for understanding this relationship. However, it's important to note that these assumptions are idealistic and don't necessarily reflect the complexities of the real world. Taxes do exist, bankruptcy costs are a harsh reality, investors have differing expectations, and firms' investment and dividend decisions are often intertwined with their financing decisions. These assumptions, while simplifying the theory, also limit its applicability in real-world scenarios. Now that we know the assumptions, it's time to understand how the NI theory works. The net income theory, or NI theory, proposes a fascinating perspective on the relationship between a company's capital structure and its overall value. It suggests that by increasing debt, a company can in fact lower its cost of capital and enhance its value. But how does this work? Imagine you're running a business. You have two primary means of funding your operations: equity and debt. Equity involves giving away a part of your ownership, while debt means borrowing money and paying interest on it. According to the NI theory, if you increase your debt, you can actually lower your overall cost of capital. Here's why. The cost of debt is typically lower than the cost of equity. This is because lenders, unlike equity investors, don't demand a share in your profits. They are content with regular interest payments and the return of their principal amount. So the more you replace equity with debt, the lower your overall cost of capital becomes, which in turn increases the value of your firm. But wait, there's more. The NI theory also claims that the strategy can result in a higher earnings per share, EPS, for your company. This is because as you increase debt and buy back equity, the number of outstanding shares decreases. With fewer shares and the same net income, your EPS goes up. Higher EPS is often viewed as a sign of a company's profitability, making your company more attractive to investors. However, it's crucial to remember that this theory operates under the assumption of a world with no taxes, no bankruptcy costs, and constant interest rates. In the real world, these assumptions may not hold true. So, in theory, increasing debt seems to be a great strategy. But what about the limitations of this theory? We'll delve into that in the next part of our discussion. So, stay tuned to fully understand the pros and cons of the net income theory of capital structure. While the NI theory presents a compelling argument, it is not without its critics. Just like any other theory in finance, the net income theory too has its share of limitations and criticism. One of the key criticisms is that the NI theory operates under the assumption of a world with no taxes. However, in the real world, taxes have a significant impact on a firm's financial decisions. The existence of corporate taxes can change the entire dynamics of the theory. The more debt a company has, the more interest it has to pay. This interest is tax deductible, which creates an incentive for firms to have a higher debt ratio than what the NI theory suggests. Next, the NI theory also assumes that the cost of bankruptcy is negligible. In reality, bankruptcy costs can be substantial, and they increase with the level of debt. When the risk of bankruptcy increases, the cost of borrowing also rises, which contradicts the NI theory's assumption that the cost of debt is constant. Another limitation of the NI theory is its assumption of a perfect capital market. In an ideal world, investors and firms have the same access to information, and there are no transaction costs or restrictions on borrowing. However, in actuality, information asymmetry and transaction costs are prevalent, which can influence a firm's capital structure decision. The theory also assumes that the firm's investment decisions are independent of its financing decisions. However, in practice, these two are interconnected. A risky investment might require a different financing structure than a less risky one. Lastly, the NI theory overlooks the aspect of financial risk. As a firm increases its debt, it also increases its financial risk, which can affect the firm's overall risk profile and potentially its market value. Although the NI theory is a useful tool, it's important to consider these limitations when applying it in practice. Understanding these limitations can help you better navigate the complexities of capital structure decisions in the real world. So, we've unraveled the fascinating world of the NI theory of capital structure. Today, we've delved into the basics of this theory, understanding how it articulates the relationship between a company's capital structure and its net income. We've explored the assumptions that underpin the NI theory, including key factors like the absence of taxes and bankruptcy costs. From there, we moved on to how the NI theory works in practice, highlighting the impact of leveraging on a firm's cost of capital and ultimately its net income. We've also touched upon the limitations and criticisms of the NI theory, acknowledging that while it provides a useful framework, it's not without its flaws. Its assumptions, for instance, do not always hold true in the real world. Remember, the NI theory is just one piece of the puzzle in understanding capital structure. Keep exploring, keep learning,